Yeah, so the recording has started. So hi guys, good evening. I hope everyone is doing great. Uh, yeah, good evening guys. Yeah. So today I'll be talking about two very important concepts. If you can see my screen, thumbs up. Okay, perfect. As I mentioned on the group, today I'll be talking about liquidity and imbalance. Liquidity and imbalance. These are very important concepts that I think that you should pay very close attention to because of the severity or how important the understanding of these concepts are in your journey in trading or whatever. So now some of these things I would explain. Some of these things I would explain to the best of my ability. If you go online, you might see very different things, you might see different explanations, and that's fine. But I will explain how best understand and how or and what works for me or how it works for me, right? So that's what I'm going to do. So very quick, very quick, what is liquidity? What is liquidity? Very important question because everything that let me just tell you now so that you will understand. Everything that you will be doing here will be based on these two concepts: liquidity and imbalance. This is literally the only way that the market trades, right? Liquidity, six liquidity, and six imbalances. Those are the only two ways that the market trades. So you have to properly understand what these two things are. Now, what is liquidity? Liquidity is basically, to put it very short and simple and not too complex. If you want a more complex explanation, I will share you some other materials that you can read to understand. But to put it in simple terms, liquidity is literally just highs and lows. Simply just highs and lows. That's what liquidity is. Highs and lows. So now this is the monthly chart on the Euro USD, right? How do I spot liquidity on this chart? Or where is liquidity? So if now this is the monthly time frame. Now liquidity exists on every time frame, right? Liquidity exists on every time frame. So the rationale for liquidity or the explanation for what constitutes liquidity or how liquidity is brought about is kind of simple, right? So the idea is this is the idea. The idea is that when traders get into a trade, they have to put their stop loss somewhere, right? They have to put their stop loss somewhere. So where the stop loss is placed is called areas of liquidity. Now, look at this. Let me highlight it with the box. Look at this place, for instance. If somebody entered the buy position from here, right? You bought all the way up here. You bought all the way up here, right? Where do you think that this person is going to put his stop loss to be safe? Right here, right under this place, right under this place is going to be a protective spot. Sure, you get this place too. Same thing, right? This place too. Sorry, same thing. They will put their stop loss up here. They will put their stop loss down here. So now all these areas, all these highs and lows are regarded as liquidity, right? So all major highs and major lows are regarded as liquidity. And as I said, they appear on every time frame. So if you can access your charts, try and map out where you think liquidity is. So highs and lows are based. So this is the monthly time frame for the Euro USD. Let me map out all the liquidity that I can find, all the highs and all the lows that I can find. This is a low here. Liquidity. Liquidity is resting under this place. That's what it means. Liquidity is resting under this place. See this low here. Liquidity. See this low here. Liquidity. See this high here. Liquidity. See this high here. This current high. Liquidity. Liquidity is resting above. See this place here. Liquidity. Even this tiny one here, this tiny high here. Liquidity. You can keep finding them. See this high here. Liquidity. This high here. Liquidity. This high here. Liquidity. This high here. Liquidity. This low here. Liquidity. I think there's a tiny one here, if I'm not mistaken. Liquidity. Here, liquidity. Here, liquidity. Here, liquidity. Here, liquidity. Here, liquidity. There's a tiny one here, liquidity. So all these places, they are all areas of liquidity. As far as a high and is a low, right? They are all areas of liquidity. So, and this is the monthly time frame. If I go to the weekly time frame, I can go and still spot, more liquidity. So now, how does the market trade, right? The market trades by, I'm coming, give me a minute. So yeah, now the market trades by literally seeking liquidity, right? That's why whenever you hop on the chart, right? Whenever you hop on the chart, the first question that you should ask yourself is, where is the draw on liquidity? That's the number one question that you always ask. Where is the draw on liquidity? That means which liquidity is the market seeking for? If you look at this chart properly, right? Oh, let's go to the monthly time frame. Now you can see that we are buying, right? We have been buying for a couple of months now. We have been buying. So the question is, buying to where? Where is the draw on liquidity? Where is this where is the liquidity that this price is seeking to get to, right? With all this buying power, and it's right here. So now that, see, this is how, let me now explain it to you. This is exactly what makes trading more simplified, right? This is exactly what makes trading more simplified, and this is why you cannot trade every day as a day trader. Now look at this draw liquidity on the monthly time frame, right? Based on the way the price has been trading aggressively to the upside, it has to get to an area of liquidity, right? It has to seek liquidity. There has to be a draw on liquidity. This area is the draw on liquidity, and this is the monthly time frame. So when I know this, that means that every month I expect that we are buying towards this place. So if you know that you are buying, there is no reason for you until we get to this point. There is no reason for you to try and enter the market and be a seller. There is no reason for you to try and be a seller. Do you see how easy and simple it can be? Now this is the month of, let's say this is the month of this was April of this month of this year, this February. So literally from February, we've literally had from February we've had a sentiment, a particular sentiment that we've just been following since then. And so you have no reason to be selling. All you're going to be looking for now is sell setups. I mean, buy setups, buy setups, buy setups. Anything that is not a buy setup is not a high quality trade. And from there, you can easily sieve out bad trades. You see, over the last couple of weeks that I've been teaching or I've been doing this mentorship, right? I've been teaching you how to really sieve out bad trades, which is very, very important. How you can easily sieve. This is another method of sieving out bad trades because you have a draw on liquidity here. You have a draw on liquidity here. All you need to do every day when you wake up is, do I have a buy setup today? If yes, trade. If no, walk away. As simple as that. As simple as that. Right? And this is months of bias, months of sentiment. So until we get here, who knows when it can? It might be August, right? So until we get to this point, we're going to have to keep buying. And from there on, it's very easy because all you just need to do is buy. But you know that the market cannot just be buying all the time. At some point, it will be selling. If you go to the weekly time frame, you see what I'm saying. You know, it will have pullbacks. The market does not move like this. Sorry, give me. The market does not move like this. It does not just move straight. You know, the market goes like this. It will have pullbacks. It will go again. It will have pullbacks. It will go again. It will have pullback. It will go again until it eventually reaches its destination. You get until it eventually reaches its destination. So all you need to do is wait for pullbacks like this one here and buy again. Wait for pullbacks like this one here and buy again. So that's literally all we on the chart looking for. Why? Just because we have a draw on liquidity. Let's go to another chart, for instance, now and see. Now, if you go to the DXY, you know the DXY moves inversely of the euro USD. So if you go to the monthly, when we come here and ask ourselves, where is the next draw liquidity? Simple, it's here. This is the next area of liquidity that is on the chart. So until we get to this point, we can now be like, okay, let's slow down and wait for the market to give us more information. But for now, it has given you all the information that you need. Right? There's liquidity resting below these lows here. So let's go to another chart. This is the pounds. Same thing, same idea. Where see the way it has been buying aggressively. Here is the next draw liquidity. Sorry. So when it gets here, it might decide that okay, it wants to now come back down or pull back and keep going up. If it keeps going up, where will you be looking for? More areas of liquidity. You have here, you have here. So you get, so that's literally what liquidity is, right? If you go to another chart, this is the Euro GBP, right? You can see how messy and choppy this pair is, but regardless, you can still find areas of liquidity. You can still find areas of liquidity. Here is a drawn liquidity. Based on this last candle, this last candle was is a buy candle. So if you go to the Australian dollar, you can go here and also frame something. Here looks like the likely drawn liquidity. On the monthly time frame, you go to the weekly time frame, you can just always, that's how you get your bias. That's how you get your sentiment. It's easy like that. GBP, JPY, see how easy it is. Where is the next area of liquidity? Here looks like the next one. Here also looks like a nice target. But at least we'll get to one before we get to the other, right? GBP, JPY. Like that. Even Bitcoin. Even Bitcoin, all these things play out in Bitcoin. So for people that trade Bitcoin, they use things like this. They use things like this too. Okay, very good. Oh, I haven't taught imbalance yet, but there's an imbalance here. There's an imbalance here. So we can very likely see Bitcoin get up to 104K, 103K thereabouts to this area before maybe going up again. Right? But Bitcoin is a very fundamental instrument. So it's a Solana, if you look at Solana, you can see from here, this looks like a nice area of liquidity. It also looks like a nice area of liquidity for Solana. So if you are a crypto investor, Solana looks like it looks good right now, just off the drawn liquidity. Just off the drawn liquidity. Like that, like that, like that. So that's literally what I'm saying, literally too much. But that's what liquidity is all about. To just put it shortly, it just highs and lows, just highs and lows, major highs and lows. Liquidity rests above, liquidity rests below. But if you look at this one now, this is the major one. This low is the major low, this high is the major high. But this looks like our neck drawn liquidity because of the way we've been trading upwards aggressively. So if there's anybody that doesn't understand what I just explained, can you just drop a message in the chat box? You don't understand what I just explained now about liquidity and how to identify liquidity. If you understand what I just explained, thumbs up. Okay. I want to believe that everybody understood because I'm not seeing any message in the chat box. So yeah, That's what liquidity is about, right? So all what market does is that market seeks liquidity. When you get on the chart every week, your first question is, where is our draw on liquidity? Where is the next target for price? You can do that on the monthly and on the week. That's why they always say do a top-down analysis. So what's top-down analysis? Top-down analysis is starting from higher time frame, starting your analysis from higher time frame. It gives you a broader perspective of what price is doing. It gives you a broader perspective of what price is doing, right? So if you already have a draw on liquidity from the monthly, from the weekly, from the daily, that makes your trading much more easier, because you already have, okay, every day I'm waking up to buy. Every day I'm waking up to buy, right? Every day I'm waking up to buy. Every day I'm waking up to sell, because you already know where price is going to go to next. You already, because of the drawn liquidity, you already have an idea of where price is going to go to next. So that's that about liquidity. Now, imbalance. I'm coming. I want to drink water. Hmm. Now, imbalance. The best way I can explain imbalance is this. What is an imbalance? Or what is imbalance in price? Now, to explain this, I would say that imbalance or imbalance is a gap that price makes when it moves rapidly. So imbalance is a gap that price makes when it moves rapidly. So when we sell rapidly or we buy rapidly, I'm coming. When when price moves when price moves rap when price moves rapidly, when price moves rapidly, it leaves certain gaps in price, or it leaves gaps in price. And the idea is that price always come back to these gaps. Price always come back to these gaps. Now there are several types of these imbalances. We have fair value gaps, which is the most popular and the most common, and the one I will be focusing on. Fair value gaps. We have volume imbalances. Fair value gaps and volume imbalances. So I will use that for an example. Now let me explain. Let me explain on the chart properly. Now if you notice, just watch this. If you notice, like for instance, when price was coming all the way down here, all the way down here, it will be opening some certain gaps from one candlestick to another candlestick. Okay, let me just draw out candlesticks instead of using price. So now we have candle one. We are buying. No, let's say we are buying. We have candle 1. We have candle 1. Okay, I said we are buying, right? Just for visual representation sake. We have candle 1 that's gone up. We have candle 2. We have candle 2. Right? You know, every candle opens from where the last one closes, right? So we have candle 2. Then we have candle 3. Volume imbalances are always made up of 3 candles. We have candle 3. You know, you can see these are very strong. These are very strong bullish candles. They are very strong bullish candles. They are closing. They are closing very bullishly, very strong. Now, look at this. Normally, ideally, we should see this wick cover up like this, right? On the way up, we should see something like this. But there are some situations whereby price is moving so fast, like I'm moving so and closing so strongly that it will now open a gap in this place. If you look where you see the gap from the high of this candle to the low of this candle, this is that gap. This gap here, let me remove the middle line. All right. This gap here, from the high from the high of this candle to the low of this candle, there's a gap here, right? This wick, this candles, this third candle's wick did not cover up. This gap is called what? A fair value gap. It's a type of imbalance. This gap here is called a fair value gap. Now, when price is now, let's assume that we have a draw liquidity up here. Price is going up here. You know, as I said, price cannot be just be buying. At some point, it will pull back, right? At some point, it will pull back. Now, price pulls back to these imbalances because now it has created an imbalance here. Price did not balance this area, so it has to come back and rebalance this area. Price has to come back and rebalance this area before it keeps going, before it continues going up again. That's why you will now see something like this coming. That's why you will now see something like this, right? This is price coming back to, oh, it's like saying, okay, let me give you a very good example. Okay, there are a lot of people here that are not in UI, and there are also a lot of people here that do not reside in Ibadan. So I'm trying to look for somewhere that is okay. Let me give you a good example. Let's say you are going from Ibadan to Ogun State, right? And you are passing through Lagos. So you first get to Ibadan. You are moving from Ibadan, right? You get to Lagos, then you get to Ogun State. Now, imagine you are now using a very fast car like a Ferrari, and then you just bam from Ibadan. You just and you already talk to your guys like, oh my guys, what's up? Oh, I'm going to Ogun State. Oh, your guys are in Lagos. Okay, when you're on your way to Ogun State, come and pick us up. Oh, so that we'll be going to come and pick us up in Lagos so that we'll be going to Ogun State together. So you're like, okay, sure. But then you enter the very fast car and you were just going, you pass Lagos with so much speed, and then on your way to Ogun State, you now remember that, I'm supposed to pick my friends up. So you do what? You come back, pick them up before you continue going to Ogun State. That's the idea behind imbalances. So now we have this drawn liquidity here. These are our drawn liquidity. These are our drawn liquidity, right? This is where price is going to. Based on these buying candles, we can see that price is heading there. But it was moving there so fast, it created an imbalance. A place where price did not balance. So what does price do? Come back into that imbalance and then continue its journey. Come, give me a minute. Trying to- Oh, And then continue its journey, right? So this is the idea of an imbalance. So if you go to your chart, you can spot fair value gaps a lot. Now let's look for some real life examples on the chart. This is the 4 hour time frame. Very good. Very good. So we are buying, right? These are our drawn liquidity up. If you look closely at this place, you can see that there's a fair value gap here. Can you see that fair value gap? You can see as price was going, created that fair value gap. It came back into that imbalance before it started going up again, right? And in fact, it created some imbalances that some fair value gaps that it did not even come back to. But as time goes on, you will know where when it will come back and when it will not come back. It's just patience. See this one that is here now. Price did not come back to it before it continued going up. But as time goes on, I'll explain why it doesn't come back sometimes. But you understand this logic. What is it? But this is what fair value gap is. If you go to the daily time frame, you'll find a lot of it. Now, if you look at the daily time frame, see the fair value gap here. As price was going on, I remember that he has friends in Lagos State. Oh, it came back, picked them up, continued, and now it's created new fair value gaps. Price was moving so fast in the last couple of weeks and last week that it created multiple fair value gaps. You can see that we have one here. We have one tiny one. If you look very closely, we have one tiny one here. We have a volume imbalance here. I will explain what the volume imbalance is. Oh. We have another fair value gap here. We have another fair value gap here. These are all the fair value gaps and volume imbalance that was opened just last week. But price we have to come back to one before it continue going, because our drawn liquidity is still up, right? And remember what we said, our price cannot just be flying. It will come back down at some point. Pick up his friends in Lagos before it continues going back up. So I'm coming. That's the idea of, what fair value gap is. Now, what is a volume imbalance? Which is also very simple. Volume imbalance is a situation where price opens, or where price did not open at the closing price of the previous candle, but goes in the same direction. We know, everybody knows that it's a normal principle that every candle closes where the former candle, every candle opens where the former candle closes, right? Now, look at a situation like this. See where this one closed. See where this candle closed, but see where this one opened. Now, there is a gap in that place. This is a volume imbalance. Price also reacts to volume imbalance. So, for instance, now, see this fair value gap here. Price might not get to this fair value gap here because this volume imbalance might stop it. Price might not get to this volume imbalance here because this fair value gap here might stop it. But they're all imbalances. Do you get the point? So that's what the volume imbalance is. A volume imbalance is where, but you can see that it's in the same direction, right? It's a situation whereby price, it goes in the same direction, but it does not open where the former candle closed. It opened above it. Unlike this one, you can see where this one closed, see where this one opened. See where this one closed, see where this one opened. See where this one closed, see where this one opened. See where this one closed, see where this one opened. But look at this one here. Now that opening there is a volume imbalance. That opening there is a volume imbalance. We also have one final one which I was trying to remember, which is gap imbalance. This one happens a lot, especially when something interesting happens over the weekend. When something interesting happens over the weekend, like maybe war, or Trump says some crazy stuff, or some crazy stuff happens over the weekend, it's possible that the new weekly candle, price will not open in the same place that it closed. This is a very good example. This was Monday's candle of last week. Monday, Tuesday, Wednesday, Thursday, Friday. Now look at the previous week. See where the previous week's candle closed. It closed here. It closed here. The normal rationale is that it's supposed to open here, Abi, but look at where it opened. Look at where it came to open. The new week. See how far it opened. Before it closed up this place, this entire place was a big gap. I'm sure if I go to the lower time frame, I will be able to see the gap. Okay, very good. Can see this big gap. If I keep going lower, probably the gap will stay here. See this big gap. See where Friday closed. See where Monday came to open. Right? So that's called a gap imbalance. And you don't want to be on the wrong side of this gap imbalance sometimes. It messed me up last week because I was in a swing trade last 2 weeks. And my stop loss was in a very safe position. But because of the fact that Trump bombed Iran's nuclear facilities, and cause some kind of escalation of the war between Iran and Israel, price did not open in that same place, and price opened below my stop loss. So I lost shitload of money to start the week. So it happens. Things like that happen sometimes. That's why during this period that Trump is in office, I will not really advise you to be leaving trades over the weekend, because a lot of things happen over the weekend. Right. So that's literally just the logic. So we have fair value gaps, we have volume imbalance, and we have gap imbalance, right? And I've explained it to you. So what price literally just does is, when we have a drawn liquidity, whether it's a buy or a sell, let's assume it's a sell, this is drawn liquidity here. What price does is that it will be coming down to that drawn liquidity, but leaving imbalances, coming back to rebalance, then selling off, leaving imbalances, coming back to rebalance, selling off, leaving imbalances, coming back to rebalance, then until it eventually gets here. When it gets here, then you can now pause and say, okay, let me take a break, because I don't know if price wants to continue going down, or we now want to reverse. If you are reversing, see this very good example now. If you are reversing, this high here becomes a new, because remember it's going to be a new high. It will become a draw liquidity. So price will be doing the same thing. It will buy, creating balances, rebalance, continue, creating balances, rebalance, like that, creating balances, rebalance, until it gets to this drawn liquidity. Until it gets to the drawn liquidity. So sometimes trading can be that easy, you know, it can be that easy. Can be that easy. Then in subsequent classes, we'll go into other things like market maker buy and sell model, other concepts like order blocks, breaker blocks, like that. But you can literally make a living off fair value gaps, draw on liquidity, or understanding the draw on liquidity on, let's say, the daily time frame, the fair value gap that is going to draw to, and then from there, buy or sell in the direction of the draw on liquidity. So yeah. Who doesn't understand what I just taught today? You can send a message if you don't understand. Just send a message.
My name is Fatima.
Oh, sorry. If you understand what I just taught, thumbs up. If you understand everything I just taught in the last 1 hour, just thumbs up. About liquidity and about imbalances, and how price goes from imbalance to drawn liquidity, imbalance to drawn liquidity, imbalance to drawn liquidity, imbalance to drawn liquidity, until we eventually get to drawn liquidity. Okay. I'm guessing everybody understood, since I'm not getting any messages. But on the group, I would open the group for a couple of messages or questions that you might need, you might want to ask. Sorry. So yeah, this will be the last class until August, because we have exams coming up, and I have to focus on that throughout the entire month of July. So I hope you guys are doing your best at life, and I'm glad I could provide value tonight. So yes, that's that about that. Have a good night. Have a good week, and